You see that thing, Bill, that we were looking at? Psychotic, right? This thing, look at this bad boy. I thought it was when I first heard about Carvana, like in the height, it caught some action and people were trying to explain to me what they do. And they were like, car vending machines. Yeah, I thought it was a joke. What do you do with that now? What do you do with that? Yeah, I guess like a parking lot. But McBob, you ever see how these things work? Like the cars go up and down. It's like elevators in there or something. Retail versus SPX. From what house, Ani? Do you remember what firm it was from? Tweeting. Oh, that's the retail hedging, spot gammas thing. The delta hedging. You talking about that? Oh, so you know how spot gamma has the delta hedging in chart form? So in other words, how can I explain it without making you dizzy? I make myself dizzy. In simple English, if they're buying calls, right? If it's if it's bullish hedging, the line will be going up. Okay. If it's bearish delta hedging, the line would be going down. So what that chart was showing earlier was as the market started to fade in the morning, retail was positioning bullish into it. And then they got caught. You know what I mean? That's what I was trying to point out. So basically, at 10:30 this morning, if you remember what went on, the shenanigans today, and my God, were they shenanigans. Here. Okay, so what I was trying to point out there was, see this? Retail came in to buy that, basically, in simple English. And then they got caught. And then I don't know if you saw the chart last, what happened is eventually they gave up and they started, unwinding some of that. I think it completely unwound by the time this happened. I got to look at it. Right, small lot, exactly. You don't know if what's retail, what's not. But good point, McBob. Small lot. Again, you can't, a lot of these things, you can't use them like anything else. Buy sell signals. You got to kind of put the pieces of the puzzle together. Like that's the only thing I noticed today off of that was they bought the first dip thinking it'd be a bullish day off of that NVIDIA news. And then once the market started working against them, they got caught. So kind of hinted to us there would need to be some more weakness there, but this, I'm telling you guys, the more every signal now, especially as the option market, there's very little, if any, especially the flow we've been seeing recently. Any signal beyond a day or two, if not intraday, everything right now, especially with all this weekly and same day expiration, the signal is dead at the end of the day. A lot of the action that we see, they don't even make it to open interest the next day. You know what I mean? They don't even make it to open interest the next day. So until we finally shake out, and that's why I don't think, this whole cycle is over. I think there's more work to do until we get rid of all this. And trust me, it will go, put it this way, it will at least calm down a lot. And until we get through that process, got more work to do, unfortunately. What's interesting, Ani brings up, Bova came out with a rebuttal to Kalanovich. So Kalanovich, JP Morgan, is warning about this same day expiration, possibly leading to that Volmageddon, whatever they call that, right? To that Vixplosion type event, where it catches everybody off guard, kind of almost like an exogenous event. what Bova did, they came out with a rebuttal to it and said, they don't see anything like that as of right now. Everything's tied to just solely intraday. They don't see the leverage being carried overnight, and leading to a risk like that. So who knows? Nobody knows. Yeah, nobody knows these things until they bite you in the rear end. You know what I mean? You ever see something that people are warning about and it happens? That's an exogenous event. It catches everybody off guard when they're not expecting it or not ready for it. Yeah. We're playing, playing even weeklies. It's gambling, guys. You know what I mean? You know that, Bill. It's gambling. Listen, the only thing that differentiates the market as a whole, okay, from betting the ball games or the racetrack or anything else, is that you have an opportunity to invest and minimize your losses if you do the right thing, right? Ball games, you bet on a ball game, you lose what you bet, right? And that's pretty much the options world. That's how you got to treat options, especially weeklies and stuff like that. Can you play with some sort of edge, and can you manage your bankroll appropriately to, find a way to make some money? Yeah, of course. But it takes discipline, and it's gambling, just like there's professional gamblers. A lot of people don't like to lump just the market with the term gambling, but that's what it's become. It's gambling, plain and simple, right? If you don't want to gamble, buy, dollar cost average in some of your favorite names and index funds and ETFs over the course of your career, and you're probably going to make a lot of money in the market, right? Buy some fixed income, especially now. But, you buy same-day expiration options or weeklies, you're flat out gambling. I mean, come on, I don't think that even needs to be said on this webinar. All right, let's talk about a couple things here, and then we could bullshit a little if you guys like. I know you guys like to get me going on that stuff. You like to get me fired up. A couple of things that we've been talking about. Again, members, we've been talking about it every day. But those of you who aren't members, the last couple of webinars, we've been talking about a couple things that were in the works that were pretty important, pretty significant. And I wanted to touch on them quickly here. Hold on. Let me get that one chart here, make it easier. Where is it? I got it right here. All right, so we spoke about how we were running into a little bit of an issue. All right, we spoke over the last couple of weeks how we're running into a little bit of an issue on the positioning side, more so than sentiment or anything else. All right, and let me get to it. Okay, so we were talking about how the systematic crowd out there, right? CTAs, trend following, quants, whatever you want to call them. Because of the magnitude of the squeeze, especially in certain things out there, right? The squeeze overseas in Europe, China, that, the last couple of weeks of that squeeze. You had even finally the NASDAQ in growth names where they refused to cover shorts and get long. They finally capitulated, and a lot of these systematic players, funds, got aggressively long, okay, as a whole, okay? More exposure in certain spots than others, no doubt, okay? But as a whole, globally, and that's what we were touching on, and that's what Goldman was pointing out, their tank was full as far as buying is concerned, okay? So if you remember last week, we spoke about that. A lot of people take that and automatically equate it to a market crash. They're going to need to sell. It doesn't automatically mean that, right? As you guys know, if the market, if if there's a headline, if there is some sort of event, okay, that's the fuel out there that can really get the fire lit, right? That's where you really start to see things snowball to the downside when you get positioning lopsided from these systematic funds, especially because again, there's no emotion in what they do. Okay, they're not. In other words, markets breach certain levels. Okay, and you see McElliott and even Goldman here talk about certain levels. Okay, that's their model. And what they figured out where these CTAs would have to take down exposure. Okay, so let's say, for example, they're 100% long. Okay, at 40-30, right? They got to cut down that long exposure. Okay, and there are other things that go into it too. If the VIX starts to move higher, okay, a lot of these, especially these volatility targeted funds, they go off solely what the VIX is trading at. If the VIX elevates to a certain level, they have to take their exposure down. There no questions asked. Okay, again, there's no emotion, there's no thought, there's no, let me hang in there a little bit longer because I think it's going to bounce. And that's where you get these strong momentum moves, both to the upside and to the downside. We've been seeing, in my opinion, these bear market rallies, every single one of them. Again, my opinion, I think the match was lit from these funds being caught significantly short and needing to cover some of that short position, eventually getting long, right? Because again, these aren't human beings that are chasing these levels, right? Our instinct a lot of times, unless you're a pure degenerate, you want to wait for a pullback, right? You want to wait for a better entry, right? These funds, they don't pay attention to that much, okay? So the risk was that if there is some sort of catalyst that really gets the price action going to the downside, you have a lot of supply to hit the market. Okay, I forgot the number. Oh, is the number here? We expect CTAs to sell 14 billion over the next 5 cents. Okay, and I think the number is even bigger if we trade under these levels for a certain amount of days or weeks here. Okay, so this was the risk. Now, the in-between, okay, the in-between trade that a lot of people don't focus on, right? They all focus on either the rip higher or the move lower. And this is what we were talking about last week, is something like this, okay? Where initially you get the market, they take it down, right? And before you know it, these CTAs start to cut exposure, and a lot of these tactical players start to get bearish. And then before you know it, guess what happens? You're set up for a squeeze the other way, right? Things happen so quick. So depending, we are at a spot now, and getting close to it, where if there's nothing to really weigh on, and you got some inflation number tomorrow, right? The PCE, which obviously could be a catalyst. I think a lot of people are expecting it on the hotter side, but we'll talk about that later, okay? The thing to watch here, in my opinion, is off further weakness, that's where I'd be looking to possibly play a snapback move, okay? I think the better way to play it, and I think one thing that I'm more optimistic coming out of today than I was going into today, the flow has been awful, okay? So in other words, we haven't seen any appetite for call buying in anything new throughout this whole process. Okay, we've been talking about that in the room for, it feels like an eternity now. Ever since the AI names, right? They broke out and caught some action. After that, there really was nothing left. And a lot of the more aggressive call buying really started to dry up. Okay. So we've been kind of in that mode ever since. And today, believe it or not, it took a gap up off NVIDIA, then a fade of that move. Buyers finally started to show a little bit of interest into that weakness earlier today. Again, not off the open after we faded that move, okay? What, did they come in gangbusters and start bombing things? No. But and I tell you guys to focus on this just so you get an idea. It's almost like a gauge on the quality of buying. There were a few names that caught respectable action worth paying attention to. Okay, again, they may not be the names you're interested in. All right, that's kind of irrelevant. The market's not going to do what you want. But whether you play these names or not, it's a good gauge on whether buyers are starting to show an interest. Okay, because when you get into these what they call them buyer strikes, where buyers just crawl up into the fetal position and go away, that's when the market almost becomes bidless, and you get just these bleed outs where you get some bullish sentiment signals, you still see no bounce, right? Because nobody's stepping in, and shorts sniff that out, and they get to move things the way they want them. Okay, but when you start to see buying showing up into the weakness, even though the market may not rally right there and then and snap back, that's usually the first signs that, okay, buyers are starting to get interested in some things here. Okay, and as you guys know, the indexes, I think, are an extremely difficult trade, right? I've been saying that for a while. I still think that. I think trading the indices here out, even intraday, has become a fiasco, as you guys can see. But I think even beyond that, it's just too tough of a trade. Too tough of a trade. I think the opportunity, if there's going to be any opportunity here, it's going to show up in individual names, okay? Where if you're a little bit early, you can survive. If the market is not ripping higher that day, you can still find something that can outperform and make some money. Okay, if you're going to rely solely on what the indexes are doing, and that's going to determine whether you're making money or not, that, again, I speak for myself. That, for me, that's tough right now, and it's something I don't feel I have a big enough edge in right now. Okay, what would change that? Because I know a lot of you focus solely on the indexes, and you'd rather be patient there than play names, and that, your game. What I think is we probably need more selling, if not some more chop, to reel in and shake out more bulls, right? Reel in some more bears and shake out more bulls. So, in other words, for a play on the indices here, I think you want to see a lot of the CTA selling get washed out, right? Take away that risk. You want to see some of the sentiment stuff we look at, some of the short-term positioning stuff we look at, to start signaling squeeze. Because why do I say that? The upside, right? The upside is not worth the potential downside here. It's that simple. Okay, it's not that I have some forecasting tool that's telling me where the market's going to go. Okay, you show me CTAs are in the midst of this. Okay, what do I do with it? Where'd it go? Oh, all right. CTAs are in the midst of doing this. Hedge funds as a whole, again, long and a lot more long in certain spots than others. Hedge funds are as a whole are long, so that's more supply that can possibly hit the market. Okay, those are the ingredients for any rip to find sellers in a bear market. Okay, that's the simple English out of it, right? So right now, if I was to break it down again to simple English, what I think I'm seeing right now, and I still need some more evidence on the buying side, but if buyers do show up, I think you're going to see a tug of war here, okay, where you got the systematic funds that are going to lighten up, right? You're going to have hedge funds that, because of what rates have been doing and the pricing of rates has been doing, what has been going on there, you're probably going to have hedge funds start to lighten up on some of the risk they recently put on. Okay, so that's almost a cap on the upside. And I think what you're going to have is you're going to have some contrarian buyers looking to buy dips in certain things on the downside. And that's where you see bids like today. So, for example, are they going to buy Apple or big tech or Carvana. You know what I mean? Probably not. But what they're likely to buy, based off the strength of the economy and how things are set up right now, possibly the banks, right? Possibly some of these new regime names that we talk about. Okay, like a name yesterday caught a little bit of action that fits the bill. An Archer Daniels Midland, crap like that. So I think value, right? I guess that's the easy way to label it. You're going to have some contrarian buying looking for opportunities based off the strength in the economy in value names. So I think that's the tug of war that we're likely to see over the short term, barring some China teaming up with Russia to take over the world news. You know what I mean? And you can't, that's the problem. Okay, that's the problem. You can't, a lot of times you can exclude, okay, you always worry about that exogenous event, right? But you're not going to focus on it, okay? Because the likelihood of something happening on that level is slim to none, okay? Unfortunately, we're in an environment where there are so many balls in the air, you know what I mean, that the probability of an exogenous event of some sort is certainly possible. And I think that's where all this forecasting goes out the window, right? Let me explain a little bit, just so you guys get an idea, right? Like from what I see right now, okay, and this is right now, could change, right? A lot of times in this type of environment, it's going to change. But what I have been telling you guys and what I'm seeing, and I haven't had any information to change that theme, has been a market that kind of doesn't do a whole lot. Everybody's looking for the crash. Everybody's looking for the start of a new bull market. You have chop, right? You have ups and downs with possibly a slight bullish tilt to it, net, okay? But under the hood, you have names, opportunities in individual names where you can really find some alpha, okay? And the likelihood is the bulk of the names that should do well are the names tied to the economy. Now, you probably think I'm nuts. Why? Because everybody, think about what was the contrarian trade coming into this year. Everybody was expecting everything to blow up early on. You buy that weakness, and it's the start of a new bull market into the second half. Everybody and their mother was on that trade, right? We spoke about that. Everybody was on that same page, okay? And what's playing out is the total opposite, where things look like they're hanging in there. There's no recession in sight. The economy is actually showing some strength here, right? That's the fear now, that the economy showing some strength may lead to inflation perking up again, okay? So the total opposite of a recession, right? So what you're seeing is a lot of those names that were getting priced in for a recession tied to the economy have been catching bids, right? So I think that continues, right? These names will find buyers into weakness as long as the economy remains okay, right? Something doesn't break, right? And, the Fed doesn't start rigging the game again with 75 bips, and pulling the strings. So those are big ifs, right? We hate ifs, but there's no way around them right now. There's no way around them. So that's what I continue to see. And I think we are in, we were in the up cycle of this kind of sideways move, right? That's been going on from the summer. People are just talking about it now. This has been going on for a lot longer than the last couple of months. This has been going on from the summer, okay? And I think just right now, we are in the downshift of this cycle in this trade. And I think that's a good thing, because I think off these pulls that there's high correlation amongst a lot of names, that's where the best entries are going to show up. Think about all the big winners that stem from here and here. All right, that's what can possibly happen off this poll here that we're seeing now. So that's why I'm so focused on what names are catching action, if any, into this pullback, as opposed to, all right, are we going to bounce here? Can I catch a squeeze here? You know what I mean? Because I think the bigger opportunity for a rise is elsewhere. Okay, and just on that note, if they're not buying any names, okay, that's the biggest red flag we could possibly find. Okay, if there's no risk appetite and nobody's looking to put any money to work into this pullback, okay, they're doing that for a reason, and ultimately that could mean there's a change in this playbook that we've been talking about for a while now. Anybody have any questions? Because I know this could get confusing, especially, I'm no presenter, so I'm not the best at presenting what's in my head. But does anybody have any questions? I know we've been talking about this playbook for a while, so for everybody who's around, you kind of have an idea what we're talking about. But everybody follow what I'm trying to say? Right? So wait, how come I don't see? I see raised hands. Where is that coming from? Am I missing something here? Hold on. Oops. If you have a question, just shoot it out. If for some reason you can't type, what did I do? Oh, here we go. What separates the CTA's portfolio managers that are just positioned based on weight? Well, basically CTAs, and again, in simple English, are trend followers. Okay, so I'll give you an example. Okay, and I could pull up a chart that will show it even better than this. Okay, but here, and then we'll look at the chart to confirm it. Okay, very simple, right? As this happens, okay, and VIX trades lower, right? Usually when the market's rallying like this, okay, these systematic funds are following trends. So as this happens, they just automatically, if they're short, are going to cover shorts as the price action moves higher. And then eventually, okay, just by the way they're set up, get long, usually at or near the peaks of these bear market rallies. Okay, now you're probably saying, well, why do they do that? In a bear market, in a choppy environment, okay, they lose money. Okay, they get chopped up. But in a trending environment, okay, if you get a strong trending bull market, or even they've done well in the bear market because the rallies have been short-lived, they kill it. Okay, because think about this, right? They get short into the COVID crash, right? They make some money on the downside, and then this happens, cover short, cover short, cover short, max long. You understand? So that's why they're in business, okay? Because the market does trend, right? More than not. I think that bear market environments, they even trend, okay? Those choppy ranges, they don't last long for the most part, so they kill it, right? And, they're set up systematically. They're not, you know what I mean? They're not run by people making decisions, so it takes the emotion out of it, right? But when you get into more choppy, range-bound environments, a lot of times what you'll realize is when they get heavy short, when they get to a certain threshold, that's usually near a tradable low. And when they flip long, that's usually where that bear market rally runs out of gas, right? Because they move markets when the liquidity is so low, right? That's a big buyer. Like, I think that was the most important thing Goldman stressed when they came out and warned us that their model was showing that their buying was done. Okay, the Goldman guy hit the nail on the head. One of the biggest buyers in this bear market is gone. Okay, one of the most important buyers in this bear market, okay, in this bear market rally were CTAs. Okay, and what Goldman was making the point was here, they were done. You understand? Their tank was full. So I think that was even more of an important takeaway than the potential selling it could lead to. It told you that, you know, the crowd behind this was out of ammo. I mean, that's pretty important intel, no? All right, so you can see the how important the information is, especially in these type of environments. You know, so again, great question. But that's the difference. They follow trends. I want to show you a couple just quickly so you guys know exactly what I'm talking about. And you've seen these charts around. I throw them around. People who follow this stuff on Twitter, look here, right? I think this is what they're pointing out here. What is it? CTA positioning. So the green is SPX 30-day return, right? And this is the black is the CTA positioning. Okay, so the black line right here, right? That's where they are. Okay, coming into yesterday or today, that black line. Okay, and you can see, right, when that black line usually gets to the top of this range, all right, the market needs to start selling first, so it doesn't have to happen right away. But when the market sells, right, they got to see the percentages here. They got to take that exposure down, and look how closely that green line moves with it, and that's SPX returns. So it's obviously well worth following. Let me get to this stuff here. Oh, I wanted to hold up. Just because the charts are pretty good looking. I hear my dogs barking. You don't. I'm on the other side of the house, and these dogs are barking at the top of their lungs. Where's the? Oh, you know what's a good example too? Here. I thought I had it blown up that you could see. I don't know if you can make it out on your end, but here's the S&P 500. Okay, and here's the NASDAQ. Okay, so you can see here how the green shading is that CTA exposure. Okay, so you can see how heavily short they were here, right? Down to that 15% number. Okay, and the market didn't bottom and rip higher immediately. Okay, but you see how that green shading starts to move up even before the market does, in a sense, because they had any little uptick, they would have to cover some of that short position. They were already maxed out. And then eventually, boom. Right? And then they come down here again. They add some shorts and they cover, flip long. Boom. Okay. Here's this back in February here, right? You can't make out the prior, but they were short, flip long. All right. Again, market didn't top out immediately soon as they flip long. But then eventually, if we're in a bear market and we're going to make new lows, right? They're obviously, or even we're going to go anywhere near lows, you're going to see them sell and put shorts back on without even any thought process behind it. Can they see this too? Yeah. Again, that's their goal. How about this? Okay. You had the big quant guy on Bloomberg today. We were listening to in the room today, Amar. I forgot his name, but he was on Bloomberg. He was saying he thinks one of the best hedges, okay, in a bear market are these CTA trend following quants. Okay, why? Because if something traumatic happens or you go into an extended bear market that trends, you're gonna make a ton of money. You understand? And if you're worried about missing a new bull market, right? That covers you there too, because if that happens, they're going to follow the trend. There's no decision making in it. So if you're looking for a hedge, right, against that type of move against you, instead of buying VIX, instead of buying puts, instead of buying that instantly cost you money, and sometimes they don't even hedge, right, what you're looking to do. He was making the point that he thinks that's the better hedge. That's how efficient they've been. Yeah, and that's right. Think about the market these days, especially, right? Everything, it's incredible how sentiment shifts from one extreme to the next constantly. It's amazing. It's a more and more, especially with the more and more machines come into play, right? The more you're going to see that type of action. It's been around since I got in the game, before machines were even alive. Now forget it. Yeah, the algos, they're already programmed. Exactly. All right, so we've talked about the importance of following this stuff, especially in this environment. Because you don't want, like, I give an example, okay? In a bear market, okay, you don't want to be off sides at those extremes. You want to look for turning points at those extremes. And there's no other way. The price action is not going to tell you where that turning point comes. Again, listen, you're talking to the wrong guy, because I'm biased with the stuff. I think positioning is everything when it comes to the market. Like, you need to know where positioning's at if you're looking to find any sort of edge, turning points in this game. There's no other way. Those are where the slingshot moves, the best risk reward type moves stem from, those extremes. Retail investors, traders, how can we fight these machines? You don't look to fight them, right? You're not up against the machines. You look to take advantage of them. That's what you look to take advantage of them. And again, you're never going to be faster than the machines. You're never, right? You're never going to be able to do what a CTA does, right? Because you're emotionally wired. It's impossible. The extremes are the only advantage you have over them. Positioning, everything we talk about on this webinar at all times, positioning, how funds and players are positioned in the current market, right? And with the tools that we have access to today, again, I'm in my rocking chair. We never, when I got into the game, you never had access to this information. Now we know on a day-to-day basis what hedge funds are buying. Right? We know on a day-to-day basis, updates every day on how CTA and systematic funds are positioned to the date we know. Right? You never had access to that information. So again, the edge of that intel, okay, is not buy sell signals every day. You know what I mean? That's not where it is. The edge is off extremes that get your attention where you can start looking for turning points. Or even a simple takeaway like we just spoke about a couple of weeks ago, right? When this happens and we have knowledge now that CTAs are out of ammo and that big buyer is out of the market, do you want to get long? Would you rather be long when CTAs have a ton of ammo and can buy hand over fist for weeks? Or do you want to be long in a market where CTAs have no more ammo left and you have none of that support? I mean, that's just common sense, right? Right, or you could get dumped on. Good point. Well, exactly. And these bear markets, the liquidity, it magnifies it even more because the liquidity is so awful out there. They move markets. They move markets. Right? So, like for me, again, the reason I say the indexes are too tough here for the type of trade, especially a lot of you are interested in, I think you need some of this positioning to shake out for you to have an edge at the index level. Okay. Can we get to a point here? And I think we're going to get pretty close to it if we get a little more weakness where we can snap back rally to like something like this, without a doubt, without a doubt. But in all likelihood, it's going to find sellers. It's going to find sellers. But if there's buying in individual names while this is going on, you can have something that looks completely different. Completely different. All right. So let me give you an example of a name today. And again, I know this is not your cup of tea for most of you. Okay. But again, this is just today's action. All right. There hasn't been much buying, period. But like a name like this, okay, is a perfect example of what I'm talking about. Okay. Market was selling. This thing was strong all day. Market recently is, in a downtrend. Most earnings are a disaster. This, in the particular sector it's in, it's a shipper, tanker, whatever label you want to put on it. Okay. Doesn't catch much buying. Right. A lot of us never heard of the name before. Okay. And today you had multiple sweeps come in, even while the market was a mess, right? You have weekly puts, calls in Tesla, Apple calls, puts, nonsense all day long. Okay. And they come in and they start sweeping calls in a name that catches no action. Okay. They open the largest position of open interest in the name. Okay. There's nobody else in the name. We know exactly who owns it. Okay. They just come off. You have company after company reporting disaster earnings, warning, guidance, you name it. They just came off a blowout. They reported $1.20 a share. All right. They were looking to do 75 cents. They earned $1.20 a share for the quarter. All right. So complete opposite of what's going on in the market. And that's the point I'm trying to make. Now, you think, oh, well, a fluky name, right? You look at the names in this group, and if you've been playing these names, and I know quite a few of you have been trading them, it's been anything but a bear market for you, right? Most of you know this guy, this beast. Stinger, right? Another tanker. Right, there you go. Praveen knows all of them, right? This name is going to report earnings coming up here. Little guy, $3 stock, NAT. There's a bull market in these names. It's not a bear market. It's a bull market. And, that's what we're starting to see more of since even before, but let's say the October lows, because again, the economy has surprised to the upside. Did you guys, by the way, talking about to the upside, have you guys seen like the Citi Economic Surprise Index or the Goldman Economic Surprise Index? Did you see that chart? I don't know if you guys seen it recently. It's ridiculous. Full-fledged breakout. And, that doesn't mean necessarily the economy's game buster. It's just telling you that everybody was caught off guard. Let me see if I can find it like this. Ooh. There it is. Oh, look at me. I'm sharp today. Look at this. Okay. Everybody, including me, guys, including me. Okay. I'm no different. I was expecting this over here. I thought the Fed would break something by now. I thought the economy, the wheels would be coming off, and I thought we'd be talking about rate cuts. Okay. But I'm in the same pile as everybody else. Everybody was on that page. Everybody. Okay. And this caught everybody off guard. Okay, and that's what we're seeing right now. Okay? And it's been playing out. It's not just started, but since the October lows, we've seen it from home builders, we've seen it from shippers, right? We were talking about the industrials were one of the first batch of names that were going bananas. So that's the reason behind the move. That's solely the reason. Okay. Now, again, I don't know how much of a contrarian trade it is anymore, but that contrarian trade that we were talking about coming into this year, remember before New Year's, we said the contrarian trade is obvious to all of us. Everybody's looking for weakness early, buy that weakness, and that's the new bull market. Okay, if you're a contrarian at heart, something completely different, if not the opposite, is going to happen. And that's kind of what we're seeing right now. All right. And if you still believe in that contrarian trade, okay, that's the playbook. The playbook is things hold up underneath the hood. You're going to find bull markets in certain sectors that are doing well because the economy is doing better than people thought. Okay. And then the opposite of what everybody's thinking, the second half, right? That's when things may fall apart. Possibly. I don't know if they're going to fall apart in the second half. I was already wrong initially. I have no idea. Nobody has any idea. That's the annoying part and the beauty of all this. Nobody has a clue. Nobody has a clue. DHT, that's another one, right? Yeah, DHT. That's another shipper. So there's just a re-rating in certain things that are out there right now. And that's what we got to kind of look for. And it doesn't have to be sectors. It doesn't have to be sectors. It could be just individual names. Right? Like somebody just mentioned this IQ. I can't get over the constant buying in this thing, and it's been going on for a while. The stock has already rallied in a pretty decent way. But there's still bullish positioning in it. Okay, maybe because of AI or whatever. But again, there are bullish things like this. This is what? HLX. This is not a shipper, is it? Oh, it is a shipper? Wow. I didn't know this was a shipper. I didn't know this was a shipper. Interesting. All right. And I can't keep track of all these things, I used to be so good I never forget a symbol, but now my mind's like mush, Rob. Now, and I think this is important to remember too, we're going to go through times, even if the playbook remains intact, okay, and there are things to take advantage of under the hood. We are going to go through times where the good stuff rallied significantly and they need to breathe. They need to consolidate. They need to pull back. And you're going to get this with everything moving with it initially. Okay, so even the strong stuff, you're going to see consolidate or pull back. Okay, the sweeper edge comes in where when we see them start to buy new names into this, okay, kind of like that EURN. Again, today was just the start. The flow's been awful prior. That's likely going to be the next round of potential winners in this phase that we're in. All right, makes sense. The things that we are watching that will likely signal because put it this way, guys, this is not going to last forever, okay? It may last a lot longer than we all think or like or whatever, but the inevitable is, okay, and a lot of us think that it's going to go that way, okay, especially if the economy starts to deteriorate, okay, but eventually this playbook is going to go out the window, Not going to last for the rest of our lives. So it's important that we keep an eye on the, on the things, on the signals we use to pick up on those early warnings, right? And the credit market is, where you will likely see some of the early signs. All right. So again, good example. We talk about the credit default swaps, the spreads, right? Those, if the wheels start to come off the economy, okay, before we even see it, you're likely going to start to see the movement in the swaps and spreads. Okay. You're likely going to see credit underperform before even we see news out of the economy that things are getting worse. Yeah, like exactly, like stuff like that, McBob, right? You're going to see it there before you're going to be able to pick up on the news coming across CNBC or even in the equities. You see it there first, right? So you can look at it, on a micro, smaller time frame, or on a bigger time frame. And I'll give you an example of a smaller time frame, right? Today, you had a gap up, big fade. It looked like the market was ready to roll over. Everybody knows about the CTA selling at this point, right? It just felt like the market was going to fall apart, right? This morning, okay? But what was interesting was the credit markets, even with the fade, the market going from green to red and selling, the credit markets, it was still firm. They were still fine. Okay. And that was just a signal to us, telling us like, all right, listen, this is just normal selling shenanigans in the equity market. There's no warning out of the credit markets that, this is going to turn into something bigger, or even more simple English, that our playbook goes out the window. So if you see buying into that weakness, it's an opportunity, where as opposed to if you were seeing cracks in the credit markets, nothing's an opportunity. And then you could see like, a lot of these credit ETFs and stuff started to firm up even before the market squeezed. You know what I mean? Even before the market squeezed and rallied. They led. Again, that's on even the shortest of time frames, but you can look at it, on larger time frames as well. Look at this, right? If I'm not mistaken, this was one of the earliest tells, right? Look, and even LQD, because that's like corporate bonds, right? So, okay, you want an early tell? Market ripping, right? Fang ripping, everything still going gangbuster. Looks like bull market never coming to an end. Look what credit was doing. Right? Look what credit was doing. This was 2021. Equities, if you remember, breadth started to narrow out in the equity market. Remember, it was just FANG. We were cursing it out. FANG and Tesla, those were the only things working and catching action and all that stuff, right? The credit markets were signaling that the playbook was changing. You know what I mean? And then, right, while the indexes were making new highs, exactly. And then once this happens, once you're there, you're not buying anything into that. Okay? You're not looking for tankers. You're not looking for jack shit when this is going on. All right? Because that's a problem. You understand? That's a problem. Now, again, the Fed was mechanically doing this on purpose, right? They were tightening the spigot on purpose. All right. But that's why, for the bulk of this bear market up until actually a little before October, I wasn't even looking at names because it was a waste of time. Right. And this is like what we look at. Okay. There's been nothing to see here. on these things for this whole move since October. Nothing to see. Okay, but we look at it still every day. Why? Because we don't want this to sneak up on us. Okay, if you're long and this happens and you have to stop out of whatever you're in, that's fine. But you don't want to get caught off guard when spreads start to widen out. Okay, because nothing, while this is going on, okay, nothing saves you. Nothing. The machines take over and they sell everything. Everything. You have to look at composition of the industries. There were a lot of those had energy names that aren't really at risk anymore. Which one? Oh, the junk high yield stuff you're talking about, McBob, right? The ETFs? Yeah, remember all the shorting and high yield off energy? People thinking that there was going to be a big problem in those high yield ETFs when energy was in shambles. I remember a lot of size put buying that went poof, trying to bet on that. Yeah, so, again, the normal gyrations, right? Day to day is no straight line, but what you don't want to see is, you don't want to see this start almost like a stock chart, right? You don't want to see it uptrending. And if it's ripping towards new highs, right, you want no part of it. You want to step aside, wait for it to top out, and then, right, a lot of times you'll see it even before the market turns, you'll see this stop making new highs. And that'll be a clue that at least the tradable low is in. But again, this in a bull market is totally useless. Right? In a bull market, I don't look at this once. Once in a blue moon, I look at it. Totally meaningless. Right? But this is telling us if there are any issues, right? Especially on the liquidity end in credit markets. And if you look at like bond spreads, bond yield spreads, I should say. Oh, come on. Oh, I know why, maybe. I hate my life, private Twitter. No. I think I just posted something on my regular, no, private Twitter is the worst. Corporate bond, let me try that. I believe it. You guys know better than me, huh? Look, it's just useless. Just useless. I got a couple questions to ask you guys about Twitter before I'm done. Because people are messaging me. I'll ask you before I'm done. So that's the story, right? If you're in the steam room, we're constantly there's a million different things that are going on. I know a lot of you guys are like me. You like to keep it simple. Unfortunately, when you're in this type of environment, you can't keep it simple. But if you're a steam room member, I'm going to bring it to your attention. Okay, so you don't have to pay attention until I bring it to your attention. But the majority of the time, we're looking at this stuff all day long, right? Another important thing here, right? Some people are just sugarcoating it, but I think it's been quite an important development since the October lows, okay? Not just the Fed, but global central banks, okay, as a whole, have been pumping liquidity into the system, okay? We all, again, for good reason, were concerned about QT and the drain of liquidity and how it weighs on asset prices, right? Again, nothing wrong with that. But what's going on in Asia between the Bank of Japan and what China's been doing, it not only offset QT completely, but it hasn't done some, right? We looked at those liquidity charts. I mean, they're mind-blowing, right? Mind-blowing. If you think it's pure coincidence that Bitcoin and all these roach motel stocks catch a squeeze like they did based on pure coincidence, you're nuts. Let's see how difficult they're going to make it here for me. Oh, here we go. Okay. Here's what we've been battling for the majority of this bear market. Okay. Here's the COVID lows. Central banks throwing the kitchen sink. Okay. QE galore, liquidity galore. Here is the Fed and central banks rigging the game now in the complete opposite direction. What the f is this? Who was expecting that? Now, you told me you were expecting that. I mean, come on. Give me a break, right? Nobody was expecting that. Especially with the Fed as hawkish as they've been, right? Hawking down every rally. Jackson Hole, you had what's his face? Kardashian, not Kardashian. You know the guy's name, throwing a tantrum. All right. But meanwhile, okay, the Fed has taken the foot off the brake, right? We see financial conditions ease. QT is still going on, but cash carry, thank you. But while QT is going on, you have the Bank of Japan all out QE, and you got China stimulating because of their reopening. Okay? This is what the whole enchilada looks like. Okay? You know where liquidity bottomed out? Exactly the October lows. That's coincidence. Now listen, the whole, what is it again? The chicken before the egg theory, right? Who knows what leads what, right? Maybe shorts, the smart money covered in anticipation of this, right? Certainly possible, but I don't give a shit who's leading who. Okay? It's not a coincidence that October liquidity bottomed exactly then and not only stopped draining, but went in the complete opposite direction. All right? Kardashians, complete opposite direction. So the rebuttal from some of you is like, oh yeah, but look, S&P hasn't done anything. Yeah, great. Okay, the S&P is just the US markets. Have you seen what's going on in Europe? What? You know? Have you seen what's going on in that? Is that? Where are my charts? They took the CAC away from me? Oh, here it is, right? Look at the CAC. Things are runaway freight train. FTSE. Even the DAX. People burning wood because they're not going to have gas and electric. Right? So liquidity, coincidence or not, right here is where liquidity bottomed. Right here. Okay. So the point I'm getting to is, we're trying to get a gauge on, okay, what happens next, right? In all likelihood, I highly doubt this is happening, right? I mean, we're not into the COVID lows here, right? So a guy like Citi's Matt King, what he's saying is once we get through like March, this is probably slowly going to teeter out. Okay, so you don't have that boost of liquidity, again, from what they're telling us. We'll see how it develops. But again, I wasn't expecting this either. So there are a lot of, and that's why I've been telling you guys for the last couple of weeks, while we have the bad setup where a lot of things, right? You had upside niner exhaustion signals across every index you can think of, every single one, right? From that to Russell, everything, every single one. Okay, just got a little too frisky to the upside. All right, you had CTAs running out of ammo. Everything we spoke about. It's just a good time to relax and let's see how things shake out, right? What are they buying into this? Are they buying into this? What does liquidity look like into this, right? What do the credit markets do into this? How do swaps trade into this? It's a perfect time to chill out and look around. Exactly what the Fed is doing, you know? And if we start to see some of the constructive signs that we look for start to show up, you know, we're gonna have some opportunity. No reason to rush. Well, this liquidity already came in. Like, look at this. This is what this chart is showing. I have another one too here. Okay, this, and think of this, right? You see here, from the 2009 bottom, boop, all throughout, right? You had this little small periods here where certain central banks attempted to drain some liquidity. But you had liquidity on your side throughout the whole entire bull market, okay? You had the COVID crash, and then this came to the rescue, right? And then 2021, okay, central banks, no more COVID, economy's reopening, they want to unwind some of this liquidity, right? You got people drawing farts, things are getting out of control, okay? You got Sam Bankman-Fried becoming a trillionaire and running the world in his pajama shorts and without a brush to comb his hair. You know, got a little out of hand. Right, nobody wants to work. Everybody wants to open up a Bitcoin or a YouTube account, whatever. They're not going to allow that to linger, okay? So they pull the rug. They pull the rug. All right? That, you know, everybody was expecting this, okay? This was because of COVID, and they needed to throw in the kitchen sink that, I mean, we were in zombie land, okay? What was unexpected, even to people who follow liquidity, even to people like Matt King, was how big of an impact Asia primarily has had on global liquidity. Yeah, you had a lot of nonsense. So that's why you see some of that stuff flaring up again, right? You see Bitcoin flaring up, right? You see the meme stocks, the heavily shorted stocks, all that stuff, AI, right? All of a sudden AI, you know, is a hype theme, all right? And works. I'll give you an example. If this AI thing, I don't care what anybody says, came out into this, it wouldn't catch a bid. You guys realize that, right? Not a bid. Those stocks would pop, and the algos, because of the liquidity drain, would go on insta-sell anytime those things flash green. Okay? If this whole AI thing came out pre-October, it didn't have a shot in hell to catch momentum. 40 times gassing it up. I know. The only reason, again, call me nuts, the only reason it caught fire is because it occurred during this. That's it. And you know what? If this does this, those AI stocks are going to new lows. Mark my words. New lows. Yeah, I mean, I don't know if it was timed well or they got lucky. You know, I don't know what it was, but you know, You know what? Was it Hartnett? Somebody, said it funny. He was like, you had uh, a ton of Japanese with an influx of liquidity on their hands and needed to find a home. You know, yeah. Basically, if you look at like what's going on over there in Japan, you have all out monster QE in effect over there, and and China as well, and the Fed taking their foot off the brake. Yeah. So it's an understatement to state the fact. It's important to know where this is headed. Okay, we don't have to predict. I would love to predict, but we can't. I have no idea. I'm telling you, even the guys, I'm being honest with you, liquidity, it's Yiddish to me. It's not something I follow. This is not my niche. It's not my cup of tea. Okay. But the people I know who follow this, okay, and I'm not even talking about friends or colleagues. I'm talking about professionals who this is their expertise. Like, again, Citi's Matt King. They couldn't even forecast this, right? So they're all looking to see how this plays out. I told you, Matt King, his last update, what he's thinking is as we get through March, you're going to see this drawdown. Okay. And if you look at a recent chart, if you look at, I told you, he's a good follow. Okay. And you want it for information, again, not buy and sell signals, okay? If you're using stuff for exact buy sell signals, you're going to end up on the street corner with a cup. But that cross-border dude who's been around, this guy here, okay? This is all he does, okay? I wouldn't recommend you pay attention to where he's talking about sweeper activity. I wouldn't recommend you pay attention if he's talking about positioning, but liquidity, he's written book. This is his thing. Okay, this is what he does. And you can see one of the recent charts. Some of the problem with him is his timeline is just so messy. But if I show you a recent chart of like China, you'll see what Matt King is talking about too. He retweets stuff over and over and over again. It makes me nuts. Here. So we're kind of in, again, there's never straight lines, right? We're kind of in something like this right now, where they pump liquidity in, they take it out. They pump liquidity in, they take it out. Why they do that, I have no idea. Okay. But that's what they've been doing of recent. I know it's, again, when it comes to liquidity, it's, and on Twitter, I don't know anybody else, I know a lot of people who pretend they know, you know what I mean? But I'm not going to vouch for them, this guy's been around a while. Right? So you just want to know, we want to know how this shakes out. Right? How this shakes out. That's all. And you're going to see all the other things follow in place if they shake out, a specific way, right? If God help us, okay? But even me, you guys know I'm not bullish on the market as a whole. I don't think we're in the start of a new bull market, all right? But if this does this, I got news for you. You shouldn't forget about what I think. You know what I mean? If we see liquidity do this, and I don't see how that could happen, but if it does, I could be telling you the end of the world's coming all I want, and it doesn't mean shit. Right? Did it mean shit when we were all walking around like zombies? So, oh yeah. Well, that's the problem, Tyler. You hit the nail on the head. That is the problem. Okay, that's the problem. And we're seeing it right now, Tyler. Right? You see, again, is it a coincidence that everything is snapping back and we see things heating up. That's the problem. Okay. And listen, in itself, inflation is not the issue. Okay. I'll give an example. Okay. If the Fed says, you know what? For what Russell said earlier, politics or whatever reason, we're going to let inflation run hot and we're just going to raise 25 bips. And hopefully those lags will eventually weigh on the economy, right? Inflation would be a good thing, okay? The problem with inflation is what the Fed has to do to combat it. You understand? There's no remedy. There's no other remedy but this. So to Tyler's point, if this does this and inflation does this, they're going to have to do this on the liquidity front. You understand? That's the problem, Tyler. That's the problem that, why leading to inflation would be a problem. The fact that it leads to inflation itself is not going to be a problem for equities. What the Fed would have to do about that inflation problem becomes a problem. Inflation itself, you would see, like if inflation got away from the Fed, you're not going to see the market tank. You're likely going to see the market rip. You're going to see commodities rip in an inflationary cycle like that. Okay? Where risk assets and commodities get hit is when the Fed tackles inflation. How do they do that? By raising rates, tightening financial conditions, and draining liquidity. And risk assets, that's the death of risk assets, right? So I think that a lot of people, just instantly think inflation, boom, it leads to lower stocks. No, it's what the Fed does about inflation that leads to lower stocks. And an example of that is this. And that's what a lot of bulls, that's their thesis right now. They think that the Fed is more afraid of burying the economy by tackling inflation, that they're willing to let inflation run a little hot for now, and they're hoping everything they did will eventually weigh on it. Okay, because if the Fed comes out next Fed meeting and they say, oh, inflation's perking up again, we're going to hike 75 bips, we're dead. Right? But if the Fed says inflation's heating up again, but we're sitting pat, what do you think equities are going to do? Right? They're going to rip. So that's the problem. That's a good point, Tyler. That's why it's, the argument for a new bull market is, it's a tough argument right now. It's a tough argument. And that's why guys like Hartnett, we didn't even talk about it. By the way, Hartnett, new update tonight, but his last one, was a pretty decent pivot, right? He was talking about the pain trade still being to the upside. That's Bova's Hartnett that we talk about. And then last Thursday, he pivoted to where the concerns about rates going higher, he thinks overpower the need for a more bullish bias here. So he's bearish, and you guys know better than me. What's his level he thinks we trade down to by March? 3,800-ish? Right around there, Hartnett. I think 3,800, maybe on the button. Yeah, I think it's 3,800, right? That's the low here. I think that's what he was, which I think I'll take that. No? Yeah, I think if you get that, I think you'll have a setup on the indices. 3,800 by March 8th. He was exact, right? Because if you remember initially what we were hoping for, and this is before we started to get pullback because didn't even look like we were pull, right? If we get this, right? Even if these are the highs, if this is the upper end of the range, this bounce, there are going to be some names that will really outperform no matter where this ends up. I got news for you. Even if we don't even bounce much, but we find a floor here, right? Just a temporary floor. You're going to see a lot of names do really well from recent pullbacks. SPY end of month. Oh, yeah. Wait, the end of February you're talking about. March 3rd, SPY rebounds, update release. Oh, you're talking about, wait. You're confusing me now. Oh, he must be talking about February 28th. The rebalancing. 28th MSI. Yeah. I know what you're talking about. Yeah, Praveen, I sometimes I get, when we go from no buying to a little buying, sometimes I get overly excited and I give the wrong impression. And I don't want to do that to you guys. The buying's been awful. Okay, the buying's been really, really bad. Okay, even before the market started to show weakness. And today it looked like, again, these aren't, household names or anything, but it looked like they were trying to find spots to put some money to work. They weren't doing that. I haven't heard anything about that collar guy. But again, I don't follow it closely enough. We usually hear about it the week of. But look at the names here, right? We thought EURN, that's my favorite of the bunch. Yeah, this name I don't know much about, but caught an interesting sweep, April 70s. Again, no accumulation. This was the only name they really showed some commitment to. The airlines, I know some of you like them more than others. I'm never a big fan of the airlines. They had some bull flow. STNG, again, just another repeat bet there. This would be a nice name. Keep an eye on. This sweep is nothing special, but this is a name that would fit the bill of new regime. Here, Picard. Like, this is what Picard looks like. And you know what's interesting? I don't know why I thought of this name. Look at this name. It's been a strong stock, Picard. Who's this now? Someone's texting me. This name, Baby Caterpillar. Like, this is just an example of what's going on here, right? In 2007, we had a similar, like, where the economy was stronger, a lot stronger than people thought in 2007 before 2008 debacle happened. I call this Baby Caterpillar, Manitowoc. Okay, similar to like a caterpillar. And look, you talk about pricing in a debacle. Look what this stock did. Okay, 30 down to 7, and now going the other direction. Just had a blowout quarter here. Okay, I saw this stock. Okay, is that what they do? Commercial vehicles? This guy here, Manitowoc? I thought they do like cranes and stuff. Oh, you're talking about something else? Yeah, cranes. I saw this name in 2007. I kid you not. Okay, before I even go there. If I'm not mistaken, it went from 15 to 150. $15 to 150. Now, again, it was different market too, because a lot of these things were doing well. Let's see, 2000. Look. This is a weekly. Okay. See this? I guess that it was even cheaper, $9. And look where it went to, 150. All right. And here's 2008. Tex. So that's probably doing well too, right? Tex. Let's see. Yeah. Damn. Jesus Christ. Some of these things got. I just can't believe how hot they got. Later, Ronnie. Small cap. Maybe Damien. Very possible. Very possible. We spoke about these names. You got Steel names, Steel Dynamics. That's been a beast. A lot of these names have done well. How long it lasts? I don't think. Honestly, I don't think anybody knows. I think put it this way: the market usually front runs a recession, and when it sniffs out later, Jim, when it sniffs out or it thinks it sniffs out a recession again, these stocks will probably sell off. What about the banks? You know what I mean? I'm not a bank guy. I can never get a read. You know what I mean? Because they're not new names. It's just, does anybody like the banks here? See, I like them off of weakness. Like if they're selling, I'm confident they'll find a bid. It's just hard to trade these names off flow. Like once in a while, yeah, they're really tough for me too. But these are the names that should find a bid off pullbacks. Okay, the Snows of the world and the Affirms of the world, I have no clue. They're in hockey stick patterns. I don't know where it ends, I have no idea. But these are the names while we're in this current playbook that will find buyers off pullback. Where that trade ends, as you guys know, is if a la 2008, right? Something breaks or systemic or, crisis. That's where it goes wrong. Like, look at Morgan Stanley. Look at it. Really strong. Things don't even dip. XLV, yeah. Well, again, for me, Sunya, I'm looking at names that catch flow. Otherwise, I look at them. If they don't catch flow, they come and go. But a healthcare name that did catch action recently, that's a stud, is this one, ABBV. There's been some buying in this name. And a decent spot, right? You had this nice move, then a yank, so you're not that extended. And this is a name that could do well, right? In the bad time. It's a defensive name. You know what I mean? Merck caught a little bit of action, but you guys know the type of action Merck could get when it gets hot. They can bomb this thing. But a couple of names like this. But again, ABBV, the best of the recent flow. ABBV. A couple of the others, we saw a little bit of action. What else is there? Anything else anybody notice? Again, this ALG, same sector as beer. Wow. Like you see the problem, Praveen, is that these things haven't pulled back. You know what I mean? That's the only problem with these things. They haven't pulled back. You would love, like a name like this, you like this name, you would love to see a pullback. That's what you want right now. You want to see a pullback. You want to see a pullback. And that's where a lot of us are hoping we're in right now is, this market as a whole gets a little choppy, some volatility, maybe some selling, maybe they'll take those down for a couple of days too, and you'll have an entry. March 200 puts have been, yeah, there's been a lot of puts, well, more so last week and the week before on these choo-choo trains. And let's see, with the whole shit going on there. No. Yeah, they're not hedging. That was they were betting on downside in these names. TCJ. Oh, uranium, right? Let's see. Oh yeah, a little pullback there. This looks good, Robert. No, looks good. You probably want enough time if you're trying to catch the break. You know what I mean? You want to give yourself enough time if you're not just trading it, but you could even trade this thing. Another one I was looking at, was it this? That looked decent. Why do his names look decent here? I think it was a CLF. Maybe it wasn't. I don't know. I'm getting confused. So yeah, well, again, pay attention to the action that comes in. Even better, one sweep could mean anything. When you see multiple sweeps, usually means somebody's taking a position, a fund, and a lot of times you just even getting in the way of the buying, you can make some money. The tough plays are the names. I know, again, trading wise, they're active, they move, and that's what they are. They're rentals to me. These are tough. These are tough. Here's the thing. There's no edge in these names from what we look at. Okay? On a flow basis, there's no edge. Gone. Okay? We all have come to that conclusion, right? Or, it's once upon a time, there was definitely an edge in these names or flow that has been flushed down the toilet for a while now. Okay? Now, for what we look at, the only other thing to look at is positioning. A lot of times these things position, right, with the overall market. So, like, my advice, anything outside of a day trade or scalp, you're probably going to find more success if you're timing it alongside positioning in the overall market. So we're just coming off a poor risk reward positioning level, right, in the overall market. So that's not where you want to get long. Okay. Right? Sometimes they'll buck the trend, but more than not, in this environment, you don't want to get long on the wrong side of positioning. You want to see a little shake and bake at the least. And then you got some all sides positioning in the overall market. You have a decent entry there, At least you have a shot. Otherwise, again, it's no rhyme or reason here. I don't know what you base it off levels. These things usually move with the market. Sometimes they underperform the market in this current environment. It's kind of, you're damned if you do, you're damned if you don't. Right? We've seen that plenty of times. You had Meta go down in a straight line and the market wasn't, right? Tesla did it here. Right? Look, the market bottomed here. Okay. Any other name outside of these FANG, high beta, crowded growth names, if you bought the October lows, you'd still count your money. That's how great of a spot it was. This, they're tough, it's tough. Like I'm telling you guys, the indexes are tough. These things are even tougher. And just rentals intraday. That's the movement's big enough where it's worth gambling intraday. Otherwise, just understand there's no real edge in it outside of that. I don't see the edge. Yeah, right. Think about that. You bought the October lows and you're breaking even now, Robert. Oh God. Talk about being sick. Woo. Oh my God. That's what knocks you out of this game in this type of environment. Make you sick to your stomach. All right. So listen, we got a ton of things to watch. Watching stuff is entertaining. Not everything's got to be actionable and putting money at risk every single time. And we got a shot of something half decent setting up out of this. Okay. Sentiment shifts quick. You got a couple days in a row of some weakness off negative news, inflation, whatever. You're going to have some offside positioning that you can roll the dice, or find even better some names off. We're getting closer. We're getting closer. All right, but we got to keep our eye on a lot of different things here. But I'm on the job, so don't fret. All right, ladies and gentlemen, I'm gonna pack it up here. I got a pounding headache. I got a pop Advil or something. Tomorrow's Friday already. We got Hartnett later on today. We'll see if he has anything interesting to add. All right, talk to you guys later. I'll see the majority of you mañana. Have a good night, everybody. Wrong button.